In this video, traders, we're going to look at exit strategy ideas, the good ideas for getting out of your trade or investment. Stay tuned. Hey traders, a very warm welcome to you. Okay, so you're in the trade's chugging along, and you need a method of getting out of the winning trade. Generally, a losing trade is going to come out when it hits our stop loss. So that's taken care of. Now we're looking at the side of, hey, the trade's going our direction, chugging on nicely. How do we have a target? Do we have a price target? What do we base it on? What rules do we do? How do we get out of it? Can we scale? Let's have a look at some details. Okay, so broadly speaking, and I know we could kind of go into multiple iterations of this, but broadly speaking, we're going to exit on weakness. We're going to exit on strength. We're going to exit near to support or resistance, or have our orders resting at support and resistance. We're going to use a trading stop-based strategy. We're going to use a volatility-based exit, or we're going to use a time-based exit. Let's look at those individually. Okay, so exiting into weakness. If you were long, exiting into weakness would be waiting for the price to retrace back from highs and come out. So you're waiting for proof that it's turned before you come out. So for example, you're long, it's chugging along quite nicely. You might say, okay, when we break back under a prior low, a pullback low, I'm coming out. There's my stop loss. That would be exiting on weakness. You'd be waiting for some kind of signal that this thing would be weak. So you'd be setting a key level or maybe a pullback zone of X pips, whatever it may be. And you're saying, hey, once the price has come back, the advantage of that is it gives you a little bit of room to maneuver. It might come back a little bit on the way up, as these little small pullbacks have done, but it keeps you in. So you've got that wide enough, and you just want to wait until the price has changed direction and changed sentiment, whatever that may be. If that's under a low, if that's a rotation, perhaps it's a double top that's occurred and break the neckline or head and shoulders, whatever it may be. You get the idea. As opposed to exiting on strength. Exiting on strength would be, okay, we've got a chug, and then we see a good, strong move higher. We're just going to exit into that trade there. That's our exit. So bomb out of the trade. We're not going to wait for a retracement. We're going to wait and see if we can time that last final flush and assume that that's an exhaustion move. Very, very strong, very, very powerful. Perhaps it's broken out of a key level. Perhaps it's like the fifth day up in a row if we're kind of swing trading on that time frame, or perhaps it's a push up into midday if it's intraday time frame, or something like that. You get the point. We're waiting for that extreme. We're trying to time that and sell it into strength. Now the advantage of that is if we're good at that, we're going to get the very best price possible. If we're not so good at timing that, this thing could go on further and further before it starts to pull back and you could be way too early. So you've got to weigh up the kind of pros and cons of exiting to strength and exiting to weakness. And of course, flip it on its head. If you were short, it would be exactly the same, but just vice versa. Exiting to weakness would be the same strategy as exiting into strength, obviously, if you were short. Okay. What else have we got? Orders near to support and resistance. I think this is probably the most common one that people use to exit a position. You have, a price that's perhaps it's opened here, it's come down, it's done some stuff. You now go long here, it starts to push up. Generally speaking, people might say, okay, there's my limit to sell at that point. Or maybe you're just going to wait for it to hit that point, and there's your exit. The price comes up, hits that level, and you're out of the trade. I think that's the most common for most people. Most traders do that because they find it easier to frame the trade that way. That's just one example. It could be that it's going up to touch prior highs. Obviously, that's harder if you're in fresh territory. You're in an uptrend. It's for fresh 52-week highs or fresh all-time highs, should I say. Very difficult to locate that. But if you're day trading and you're working within ranges and you're playing around with stuff that's already had some price action, it becomes easier. You know approximately where you're going to go. If you took a short here, for example, your target may well be, just under that low. So it doesn't have to be actually on the level. We don't always put the level there, but we might say, okay, I'm going to exit when we break that level because that's a good benchmark and framed network for me to use. All right. And I quite like that one as well, because using prior history to dictate kind of what's going on with the trade gives you an easier ability, or it's easier in my eyes, opinion anyway, to frame the trade better. All right, let's look at the next one, guys. Moving average based trading stop. We talked about this kind of thing before. You in a market, the market's chugging along very, very nicely. Your moving average, shall we use a different color pen? Let's go with the purple. Let's assume this is a 20 period or something like that. 20 period moving average, trading up very nicely with the price. As price gets higher and higher, moving average comes up, but it's always going to be a little bit of a gap between the two. comes down, pulls back, tags it, there's your exit. Very simple to execute, very, very easy to kind of manage. Downside is potentially if this thing explodes quickly, the moving average will lag and you might give a little bit back. Upside, of course, is that allows for some noise. It can explode, can mess around a bit, and then can explode again. So again, you've got to weigh up the pros and cons of that. The second to last one here I've got is volatility-based strategy. So for this one, you'd use something like an ATR, an average true range. You'd say, hey, the ATR in the day is, I don't know, 80 pips or something like that. And you'd say to yourself, all right, I want to see this thing move 2 times the daily ATR. So I'm going to be 160 pip target from my entry. Let's say your entry's there, 160 pips is here. You're just out plus 160 pips, job done. Very systematic, very critical and easy to calculate. But the problem is with this is that perhaps price won't quite get there. It's very finite. You're not really adjusting it to suit the conditions, or not really adjusting it to suit your entries. Let's say your entry is quite late and you're still looking for 2 ATRs. Maybe it's already come up 1 and you're looking for that very quickly. It might actually do 1 more half and then retrace a little bit. So it's still a good way of framing things, don't get me wrong. I like it because it's using current conditions like volatility, but there are some downsides to that one as well. And the final one is a time-based strategy, one that we often use as day traders. Swing traders can use it as well. Day trader example would be, hey, we're in the position now, we want to hold this and we want to come out at lunchtime because we know lunchtime's choppy, nothing much is happening. So we're in at the open, drives up, take out lunchtime, or we're in at the open, want to come out in the first hours ended, or we're in and we want to close it before the end of the day, or we're in whatever it may be. You get the point. It's a time limit on the trade that says, hey, we're coming out at this time, or a limit as in the duration of time. If it doesn't do what I want or whatever it does in an hour, that's my exit plan. My idea is to take this. I think the momentum's turned. An hour should give it enough time. Same with a swing trader. You're in a trade, you say, hey, this needs to do what it needs to do in a week, and wherever it is in a week, unless it's hit my final target, you might kind of complement this with a second target. You might say, okay, I've got a target of X. If it doesn't hit that within a week, swing trading example, I'm going to come out anyway. So you can kind of combine these and make them, kind of into one trade if you like. Scaling out of your position, you can even have multiple exits and say, okay, I'm going to come out somewhere on that first level of resistance. Once it breaks that, I'm going to move the rest of it to a trailing moving average, and I'm going to combine that with a volatility-based strategy that if it suddenly rips the upside, I'm going to come out and exit into strength, all that kind of stuff. So you can play around with this and tweak it to adjust what you're trying to achieve with the trading strategy, the market environment you're in, the conditions you're trading, the actual market you're trading, or the time frame you're trading, and all that kind of stuff. So different ideas to think about there, guys. Exit strategy ideas. Exit is very important, and these are just some ways that we can tweak and adjust and have a plan put together and compiled that gives us the best possible chance of making the most out of the trade that we're in. All right, guys, thumbs up if you like this kind of stuff. See you in the next one. Take care. Bye-bye.